Hello and welcome to Questioning the Manager. Today we are joined by Mike Kerley, who is the fund manager for Henderson Far East Income. Mike, thank you for joining us. So Mike, it's fair to say that the first half of 2018 has been a bit choppy for Asian equity markets. What's your assessment of the year so far?
Well, 2018 started off okay, but really as we've gone through the year, it's got more and more volatile. And there's quite a few reasons for that. Firstly, obviously, we've got the trade issues with the US and China, which has incorporated the EU and the rest of the world as well, and that's escalated as we've gone through the year. Plus, we've had rising interest rates, which has generally reduced liquidity, plus a strengthening US dollar on the back of that. So, all in all, it's been a bit more choppy, as you say, and that hasn't been great for risk assets in emerging markets and Asia in general, relative to the rest of the world.
Okay, so the trust remains quite heavily weighted towards Chinese companies at around about 30% of the portfolio. And many investors will be very acutely aware of the trade war developing before us this year between the US and China. So I wanted to know, what are your thoughts on this trade war, first of all, and does it affect your thinking with regards to the portfolio list?
Yeah, the trade war, as I say, has escalated as we've gone through the year. And if you'd have asked me at the start of the year, I'd have said, well, I think this will blow over because it's in nobody's best interest for this to carry on. 3 months ago, I became less positive because generally we had some escalation. And where we are now, well, it's difficult to see how either side pulls back. Both Trump and Xi Jinping want to win out of this. Trump into the midterm elections come November. And how they can pull back, the further it goes, the more difficult it is to pull back from. So it worries me more than it has done, and we have reduced some positions in the portfolio which are exposed to global trade. I mean, not much because we didn't have that much to start with, but where there is some exposure, we have reduced it. From the China perspective in general, we think they're handling what's going on pretty well. We have seen some loosening measures in reaction to tariffs on trade. The currency is a bit of an issue. It's been quite weak. But again, we think that it's in control at this point and we're not worried about it.
Another thing is that the portfolio is quite heavily weighted towards financial companies. Presumably this is because financials pay higher dividends?
Our weighting in financials is a function of a few things. Valuation being one point. Generally banks, insurance and property across Asia is pretty attractive. We have a higher weighting in banks now than we have done for some time. And the main reason again is value and income, etc. But also with my top-down hat on, we have parts of the portfolio that are quite exposed to interest rate rises, some of the more defensive high-yielding names. Whereas banks on the other side of that is quite a nice natural hedge, i.e. because banks are positively correlated to interest rates. I have to say though, as we've gone through the summer, that actually my expectation of a steepening yield curve and rising profitability in banks, I've lost some of the conviction in that because I think probably growth is as good as it's going to get at this point, as we saw with the second quarter GDP numbers out of the US. And if we haven't seen a steepening yield curve yet, it's difficult to see it happening from here.
Well, many investors will remember the Asian financial crisis of the late 90s, and there's a lot of poor sentiment towards Asian financials in terms of their transparency. What would your response be to such concerns?
Yeah, I think Asian banks in particular are completely different to what they were 10 years ago or 20 years ago during the Asian financial crisis. They're not highly geared, they're very well capitalized, and actually we've seen changes in the underlying economies so that companies don't mismatch borrowings, i.e. borrowing in US dollars against local currency revenue. So I think that the possibility of a crisis, an Asian banking crisis, is much less now than it ever has been.
And have there been any significant movements in or out of the portfolio this year?
We haven't changed that much in the portfolio. So, as I mentioned before, we've reduced a couple of Chinese holdings which had exposure to trade-related issues on the possibility that there may be an escalation. Otherwise, things that are different for us this year. Usually we would have higher weighting in technology, which we don't do. We're a little bit worried about the supply chain in handsets, especially Apple or Samsung related. So we've reduced our exposure to that sector. Otherwise, not too much really. The portfolio hasn't changed that much.
Mike, it's been an absolute pleasure. Thank you very much.
Thank you.